A beginner's guide to investing different types of investments. Investing is a fundamental pillar of personal finance that allows individuals to grow their wealth over time. For beginners, navigating the world of investments can be both exciting and daunting. Understanding the various types of investments available is crucial to making informed decisions that align with your financial goals and risk tolerance. In this video, we will delve into different types of investments, including stocks, cryptocurrencies, bonds, real estate, and business investments. Before we get started, subscribe to our channel and turn on the notification bell so you never miss our latest content. Stocks. A stock is an investment in a specific company. When you purchase a stock, you're buying a share, a small piece, of that company's earnings and assets. Companies sell shares of stock in their businesses to raise cash. Investors can then buy and sell those shares among themselves. Stocks sometimes earn high returns, but also come with more risk than other investments. Companies can lose value or go out of business. Stock investors make money when the value of the stock they own goes up, and they're able to sell that stock for a profit. Some stocks also pay dividends, which are regular distributions of a company's earnings to investors. Stock prices fluctuate throughout the day, but investors who own stock hope that over time, the stock will increase in value. Not every company or stock does so, however. Companies can lose value or go out of business completely. When that happens, stock investors may lose all or part of their investment. That's why it's important for investors to diversify. The good rule of thumb is to spread money around, buying stock in many different companies rather than focusing on just one. Bonds. A bond is a loan you make to a company or government. When you purchase a bond, you're allowing the bond issuer to borrow your money and pay you back with interest. Bonds are generally considered less risky than stocks, but they also may offer lower returns. The primary risk, as with any loan, is that the issuer could default. U.S. government bonds are backed by the full faith and credit of the United States, which effectively eliminates that risk. State and city government bonds are generally considered the next less risky option, followed by corporate bonds. Generally, the less risky the bond, the lower the interest rate. Mutual funds. If the idea of picking and choosing individual bonds and stocks isn't your bag, you're not alone. In fact, there's an investment designed just for people like you: the mutual fund. Mutual funds allow investors to purchase a large number of investments in a single transaction. These funds pool money from many investors, then employ a professional manager to invest that money in stocks, bonds, or other assets. Mutual funds follow a set strategy. A fund might invest in a specific type of stocks or bonds, like international stocks or government bonds. Some funds invest in both stocks and bonds. How risky the mutual fund is will depend on the investments within the fund. Index funds. An index fund is a type of mutual fund that passively tracks an index rather than paying a manager to pick and choose investments. For example, an S&P 500 index fund will aim to mirror the performance of the S&P 500 by holding stock of the companies within that index. The benefit of index funds is that they tend to cost less because they don't have that active manager on the payroll. The risk associated with an index fund will depend on the investments within the fund. Index funds may earn dividends or interest, which is distributed to investors. These funds may also go up in value when the benchmark indexes they track go up in value. Investors can then sell their share in the fund for a profit. Index funds also charge expense ratios, but as noted above, these costs tend to be lower than mutual fund fees. Exchange-traded funds. ETFs are a type of index fund. They track a benchmark index and aim to mirror that index performance. Like index funds, they tend to be cheaper than mutual funds because they are not actively managed. The major difference between index funds and ETFs is how ETFs are purchased. They trade on an exchange like a stock, which means you can buy and sell ETFs throughout the day, and an ETF's price will fluctuate throughout the day. Mutual funds and index funds, on the other hand, are priced once at the end of each trading day. That price will be the same no matter what time you buy or sell. This difference doesn't matter to many investors, but if you want more control over the price of a fund, you might prefer an ETF. Retirement plans. A retirement plan is an investment account with certain tax benefits where investors invest their money for retirement. There are a number of types of retirement plans, such as workplace retirement plans sponsored by your employer, including 401 plans and 403 plans. If you don't have access to an employer-sponsored retirement plan, you could get an individual retirement plan, IRA, or a Roth IRA. Cryptocurrency. Cryptocurrency is the newest asset class on this list, and it's by far the most speculative. In fact, many big-name investors don't even consider cryptocurrency to be an asset, but rather a speculative fantasy. Of course, on the other side of the coin are many well-known investment professionals who are making big bets on cryptocurrency. So what is it exactly, and does it deserve a place in your portfolio? Cryptocurrency in general is a digital currency that has its transactions recorded on a decentralized encrypted blockchain. The theory behind crypto is that it offers privacy and reliability beyond current fiat currency systems run by governments the world over. However, for now, cryptocurrency remains a highly speculative investment. Even Bitcoin, the largest and most well-known cryptocurrency, is down over 58% YTD as of September 8, 2022. The bottom line is that while cryptocurrency may give your portfolio a bounce at some point, the speculative nature of the asset class means you should limit your exposure. Investing is a powerful tool for achieving financial goals and securing long-term wealth. By understanding fundamental concepts, setting clear objectives, and adopting disciplined strategies, beginners can navigate the complexities of investing with confidence. Continuous learning, prudent risk management, and strategic decision-making are essential for building a resilient investment portfolio. Start small, stay informed, and embrace the journey toward financial growth and prosperity. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.